and Leopold Wenger, CFO at Comet. They will be moderated by Anne-Sophie Cissé, who is our fantastic Chief Administrative Officer. I will let the stage to the group.
Hello, everyone. So, yeah, it's big hot topic today. MiCA and Genius, well, everyone was waiting for Genius for quite some time. That's exactly what we were seeing before being there. So, as I say, they disagree on a lot of things, but they agree on something. It is yield prohibition for token issuer. Well, that's might be the first question, maybe to introduce it. For Circle, what do you think? Is it mostly about consumer protection, or is it about banking monopoly?
Thanks, Anne-Sophie, and hi everyone. Patrick from Circle, glad to be here. I think, first of all, fully agree. I think Genius, MiCA are more similar than not on that aspect. I think, especially when it comes to MiCA, ultimately the prohibition for the issuer to pay interest really stems from the e-money directive that has existed in the EU for now over 20 years. And I wasn't involved in that space 20 years ago, but when it was debated in the EU, the banks wanted to make sure that these new e-money instruments wouldn't compete with deposits for savings. And that's why they framed it early on when they discussed the first e-money directive as a very clear payment innovation and payment instrument. And this has then been transposed further into MiCA, where e-money tokens, so essentially more or less the same thing, just on new technology, would face the same restrictions and even go further, right? They introduced the restriction not only for the issuer, but also crypto asset service provider. And ultimately, I think that's the underlying reason for that. It was supposed to be from the start a payment innovation. And that's similar to the US, where you don't necessarily have the underlying federal e-money framework that existed in the EU, but they even put it into the name of the instrument they're trying to regulate, right? Payment, stablecoin, which is interesting. And yeah, I think the basis for doing that is exactly the same. They want to frame it as a payment instrument. They want to avoid any competition for savings with deposits.
Andrew, I know that at S&P you have a stablecoin ranking, notably about the risk associated with stablecoins. Do you think that offering yield would have an impact on the risk? What is your opinion on that?
I think to come back to a point that Patrick made, when we think about stablecoins as a payment instrument usually have a fixed value. So regardless of what risk that we might see, that there's a complexity that comes from having something that has maybe an accruing yield attached to it and using that as a means of payment. So what we do, we publish risk assessments on stablecoins in terms of their relative risk of losing their peg to the dollar, to the relevant fiat currency, which in most practical cases so far has been the dollar. We also do some euros now. But when we think about yield as a risk factor, the question is, well, what is actually being promised? So if I hold USDC in my Coinbase wallet and I'm getting some commercial reward that could increase, could decrease at any point, that isn't necessarily a promise. It isn't necessarily something that we'd be speaking to in a risk assessment. If we have something that is committing a yield to the holder, then that starts to look a lot more like an investment product. We, from a risk perspective, we need to think about, well, okay, if there's an expectation of a fund rate minus 50 bips return on this instrument, how is the issuer reserving for that? So that makes for again a more complicated thing to assess from our perspective. But that, bringing it back to the regulatory picture, that starts to sound much more like something that should be regulated as an investment. There's an expectation of return, an expectation of profit on the basis of the activity of the issuer as almost a fund manager in that case. So that becomes a different thing. So again, I think we come back to this idea of stablecoins as a payment instrument used for that specific purpose and to targeting a fixed value, the outcome makes sense in terms of those instruments not having yield. Now, why different places are getting to that outcome and how, that's more maybe a political question.
I like the idea that we have the regulatory point of view, the risk point of view, but what about the product smile? When your clients come to you about stablecoin products, are they asking about yield, or is it really truly just a payment, payment instrument?
Yeah, I think from our perspective, it goes back to the origins of stablecoins, right? I think sometimes in the current climate, we can forget that stablecoins first existed as a bridge between DeFi and TradFi, and that's where we sit from an Amina perspective. We don't typically see our clients coming from a primary perspective asking for yield. It is something that they discuss with us when they're looking at their overall portfolio and their liquidity position and understanding how they can maximize. But it's not a primary driver. They're looking for regulatory clarity. They're looking for trust, security, stability, and access to an array of traditional financial products. So we work with a lot of crypto natives that are more than well versed in stablecoins and use stablecoins for all different use cases across DeFi, but are then looking to diversify their assets into more traditional away from the Web3 world. So yeah, it's not a primary driver, but it is a conversation that we have.
Interesting, notably with all the discussion about the custody, etc. Once you get into the crypto space, stablecoins is a question, and a lot of other questions are coming associated with that, I guess. So yield might, of course, not be the first focus. When I joined crypto, what I really enjoyed as general counsel, it's they always found a way to do things. We didn't have any regulation. We still strived. We grew and we scaled. Now we have regulation, but we still find a way. That's a question for Leopold. Stablecoin issuers, they can't offer yield to holders. However, the market has found a way. So can you tell us more about it, Leopold?
Yeah, what is interesting with these topics is that currently the US market is facing what we had 2 years ago in 2024 when MiCA announced that they will ban passive yield. The first reaction of the industry was to shut down all these kind of services because at the time Coinbase, Binance and all of the exchange provided passive yield in France and in Europe. So the first reaction was to shut down and then the question where can we find some yields on stablecoin in traditional finance in something already existing, and the answer was it doesn't exist at the time, and we had to turn on DeFi. And your question, we are not rooting around regulation. We are building on it, and it's very different. When we filed MiCA in 2023, we've put DeFi at the heart of our business program, our business plan. It took a lot of time, 2.5 years to get our license. But at the end, people think that there is a mismatch between regulation and DeFi, but the fact is that we were the first regulated actors under MiCA to be able to operate as a custodian with DeFi, and we find a way to provide yield on stablecoin. There were some big disclaimers from the regulator that told us to work only with regulated issuers like Circle, Société Générale Forge, and so on. So we can't work anymore with Tether or other unregulated actors. The second one was about the transparency. They ask us to be very transparent about the risk, about the methodology, and so on. And the investors has to be aware that he is putting his fund in decentralized finance. The third one was about the whitelisting of protocol. Because some of them are saying that they are decentralized, but in fact there are a lot of centralization in the governance. So we had to file to the IMF that we will work only with fully decentralized protocol with a strong track record. So that way we started with the standard, which is AAV. And the last one was about AML. Because we are subject to AML due diligence, and we had to prove to the regulator that we will be able to conduct enhanced due diligence even on chain. That is something that is, for instance, a common topic with the stablecoin issuer, and that was the four main pillar of our license.
Interesting. I will play the devil advocate today. What do you think at Circle about the fact that some companies can offer like up to 20% yield when you can't offer anything to your holders? Is it something that is really a true limitation, or is it something that you have worked around and you have found your way and built a business model around that?
Yes, I mean, everyone knows. Sorry. Does it work? Okay. Everyone knows we, as the issuer, we don't pay any interest, any yield, and we kind of agree with the notion that if we did that, that would start resembling a security, right? I think what Leopold and you were mentioning are rather like secondary markets innovation, particularly in DeFi, where there's like lending borrowing pools, for example, in Aave or other protocols. This is not really stablecoin specific ultimately. You can also like lend Bitcoin, ETH, etc., other assets in Aave and Morpho and other pools, and you receive the same kind of yield or interest on that. That's completely disconnected from the management of any reserves from the issuer. So in that case, if it's USDC or EURC, us. And I mean, so I really see no real connection between the two. The one is the secondary market innovation from these decentralized finance protocols, and the other part is, you know, what comes directly from the issuer and the reserves. So that's fundamentally different. I personally think it's good that MiCA as a first starting point it's been the first comprehensive crypto rules globally that they kind of carved out DeFi. Because it would have been way too early, in my opinion, to start regulating or aim to start. Would that even work is another question, right? But aim to start regulating the Morphos and the Aaves and other places of this world. So I think it's an interesting development, and it's something that, frankly, we should also acknowledge is still very, very niche, right? We're here in a certain bubble, but how many people really on a average basis interacted with these kinds of pools? I mean, I would say it's probably less than a handful of percent of people that engage with crypto globally. That might be, you know, a few 100 million, but how many engage with DeFi? I think that's rather a niche market for now. And so I personally also don't think there are the same consumer protections concerns and issues that would warrant, you know, strict and imminent regulation on that part. So yeah, I think these are, you know, interesting market developments that, in my personal opinion, will also be able to help Euro stablecoins then ultimately pick up a little bit of steam, because it's very interesting to see that in some of these DeFi protocols, you can already lend, for example, EURC or other Euro stablecoins and earn more than the base interest rate that you could get from the ECB or any like banking partners. And I think that's probably a development that will only grow from here.
And Andrew, what do you think about the fact that people are risking putting their money on DeFi rather than having those regulated actors? So now we understand that the primary market is quite secure, and well, if you want to go to the regulated market, but DeFi, it's still totally unregulated. It's with MiCA, it's not acknowledged that this market would exist. It has no legitimacy. So, what do you think on your side, from a credit risk perspective? Would it be better for it to be regulated and for those people to have interaction with banks and with licensed people rather than directly going to protocols?
Well, first I'm going to take issue with a point that you made that MiCA doesn't acknowledge the existence of DeFi. It does. It kicks the can down the road in terms of how to deal with it, but it very much recognizes that it does exist and that it may present different challenges. So, book I read on holiday once last year, Nothing to Do with Crypto, 1929 by Andrew Ross Sorkin. Talks about, you know, the crisis of 1929, how that unfolded, some of the key characters and different banks involved. And it really sets the scene for why securities regulation exists as it does today and what the risks are that regulators are trying to get to with some of those features. When I think about investing in DeFi, there's an element of transparency there that you don't have in traditional markets. There's an element of visibility on governance of a DeFi protocol that exists in some cases and not others. There's then variations in risk. There are some areas of DeFi where risk starts to move on chain, becomes a lot less transparent, starts to involve more actors. And so there are different topics to address maybe from a regulatory perspective, and at least regulators have recognized that that becomes a difficult question as opposed to trying to kind of force a definition of some financial intermediary in existing regulation onto, let's say, DeFi market participants. Because ultimately, a lot of the existing regulatory and legal paradigm is based on intermediated finance, and the regulatory touch point being the intermediary that's involved. Whereas in DeFi, that may not be where the main risk sits. And so I think that's to one part of your question. To the other part on people taking risk in DeFi, I think it's important to recognize that it's still a very nascent system. We've had some episodes lately, such as the collapse of Stream Finance before year end, and more recently on the Resolve protocol that highlighted some of the maybe flaws in existing risk controls, not necessarily risk models, but risk controls around some protocols in decentralized finance. That is reflected often, not always, in the yields that are on offer. I do worry as a risk analyst that not everyone is as focused on risk as I might be when putting money into those protocols. But again, I think to Patrick's point, this remains a fairly niche market, and I think it's the right time to be having those conversations about risk.
Miles, I know that you are regulated in Switzerland, right, by FINMA. Do you also have this conversation in Switzerland? What are their thoughts today about this question, about yield? Is it something that they are looking into? Is it something they want to regulate? Or are they just waiting to see what happens?
Yeah, so from a Swiss perspective, we have a big advantage because Switzerland was one of the first countries in the world to, what I would say, properly regulate crypto and allow financial institutions to provide safe and secure access to an array of crypto products to consumers. So there's no significant movement in Switzerland at the moment. I think we're watching and learning from what's going on both within the European Economic Area under MiCA, as well as from a Genius and Clarity perspective. I think it was always well understood that MiCA probably wouldn't meet everyone's needs from the outset, and it's a big piece of new legislation. It's highly disruptive for a lot of the traditional financial companies operating across the region. So, I think there's no immediate movement. Switzerland's framework is relatively mature. We're pleased to have an open and constructive dialogue across the industry with our main regulator. Yeah.
I would just chime in here that Swiss francs and the Swiss central bank, they have probably the opposite problem, right? They had zero interest rates, have been in negative territory quite frequently. And so I read their stablecoin proposals, and what they're considering right now is even like the ability for issuers to then kind of deduct negative interest rate or pass these on from the Swiss central bank, which bears a whole lot of other considerations, challenges that I think for a separate panel, but Switzerland in that aspect is quite unique.
Yeah, I think also just to add to that, Patrick, as well, what we're seeing particularly right now is that the Swiss franc has proven to be a relatively good hedge over the last sort of 20 years. So it's not directly comparable to the euro as well. So that does create some differences in behavior, and this whole point of like whether we see it as you touched on there around like the payment token versus or means of payment versus a store of value or an investment vehicle. And I think that also is factoring into the consideration of the SMB and FINMA as well.
And I think that's what is interesting with MiCA and Genius is that we are mostly talking about a very, very big economical area. I know, Andrew, that you published a paper, S&P published a paper around this question. Stablecoin, it's affecting now those emerging economies. Is it really, what do you see on your side? it's, you know, in Europe we also always say it's a danger to see everything being USD based. So do you think that from a systemic risk perspective, is it really something that you are looking into, and will this have consequences in the next few years if we continue like this?
Okay, sorry, the light had gone off on the mic. I'll start with an anecdote. ETHCC 2 years ago in Brussels, you could get your iced latte outside paying in USDC. That solved a problem in my life because it was heavily subsidized and you could get your iced latte for 2 USDC. But in reality, people aren't going to use dollars to buy their coffee. They're not going to use dollars to buy their groceries in in European supermarkets. So when we think about dollarization through stablecoins, how that affects, say, advanced European markets versus emerging markets, that there's a difference there. I think even in emerging markets, the question's overdone. But in most cases, the research that we put out was looking to distinguish countries where, because there may be weakness in institutions, weakness in monetary policy transmission, weakness in the currency, but at the same time, strong adoption of digital technologies in general and crypto and blockchain in particular, that there could be, there are indeed incentives for people to store value in stablecoins. You could see trends where, because of the growth of that, the transmission of monetary policy becomes more difficult. Now, what we found was that actually the countries that are most at risk are those where dollarization is, in any case, already a very significant risk factor, where a lot of the economy works on kind of a gray basis through cash US dollars being driven around on motorbikes. And so there's an element of digitalization of that. Maybe that makes things worse in some stress scenarios. Maybe that does have risk consequences. But from our perspective, looking at kind of ratings and relative risk across jurisdictions, that tends to be in jurisdictions that we would already see as high risk, as opposed to something that's leading to contagion elsewhere. To come back to the developed markets, sure, there can be a concern maybe that in extreme tail risk scenarios that it becomes much easier for people to access US dollars. So if, from a central bank perspective, you can imagine that if you're contemplating, let's say, extreme geopolitical events, that might be something that you want to be at least aware of as a risk factor. But again, this growth of US dollar stablecoins we don't see necessarily affecting developed non-US dollar markets. What's maybe more interesting there is how Euro stablecoins may affect the banking system. So that's just a second research piece we put out in the last couple of weeks on that topic. Similar to the US, we don't necessarily see a strong risk of deposit flight from banks. We think that this is that the question is more, as stablecoins and tokenization kind of grow hand in hand, and you have a new generation of tokenized financial products that emerge. Is there a shift in competitive dynamics between banks, between those banks that say have been more technology forward and have the infrastructure to offer new products to their clients versus those that do not? And so again, more of a competitive question between banks rather than necessarily a systemic banking problem.
I think that everyone who was there when BNP was sanctioned, it was initially, I think it was 60 billion. After that, it was 9 billion after negotiation with the US authorities. We are all afraid of the dollarization because of the geopolitical impact, as you said, and the dollars is not neutral at all. We have a lot of legal risk coming with that. And on your side, Patrick, what do you see when you are a US company, so when you come to EU regulators, do they see you as the US kind of colonizing them as a threat, or do they see you as a partner who can help develop the EU zone?
Yeah, so on that topic, maybe 2 points. The first one is I would completely reiterate and highlight what Andrew said is on when it comes to real world payments, like we or you paying for your coffee at the point of sale here outside in Cannes. First of all, there's like no indication no data that this is currently something that is being picked up by retail. So that's not happening. And second point, it's also something that MiCA already essentially bans and caps in the legal framework itself, where for real-world payments, there's like upper caps for non-EU currency stablecoins. So that's, you know, sometimes I feel like when I read those headlines in the news, it's something that is not necessarily known to everyone, but already under the legal framework today, there is no scenario where non-EU currency tokens are used at large scale for these real-world payments. It just doesn't work under current legal rules. So that's the first point. And then the second point is, I would say that if we really believe that, you know, the internet financial system will happen on chain, it's only natural that also European companies, including here in France or in Germany, will need and use different currencies, right? The same way that a French corporation today uses dollars and pounds and euros and francs to manage their treasury, to pay their suppliers wherever they are in the world. And the same will be true in the on-chain age. And that's also why, frankly, even European players like Société Générale are not only issuing a euro, right? They're issuing different currencies because it's clear these corporations, capital market institutions, banks, they will need different currencies. And I think in that respect, we are rather a partner to these European companies, also to the European regulator. And the European goal should be to bring those tokens, those that are, you know, used, that are the most liquid, the most accessible, into the regulatory perimeter. Sometimes I feel like the debate in Europe is too much about, you know, protectionism and what should we ban, rather than let's look at MiCA, let's look at the top 50 ranking of stablecoins by circulation. Which ones of these are actually MiCA compliant? And it's only 3 of them. It's only USDC, USDG from Paxos, and EuroC. Is that a success for MiCA, that only 3 of the top 50 stablecoins are actually MiCA compliant, granting EU consumers the rights and protections under MiCA? I would argue there's much more room for growth here, and I think we should rather focus on that part.
Yeah, totally. I agree with you. So what do you think, Leopold, about, well, I remember when I was discussing with ACPR and AMF, it was in 2021, MiCA wasn't there, but they were already discussing about MiCA 2. And they were saying, okay, next we are coming to DeFi, and next we will regulate what they are doing. Is it something that you think will happen in the next few years? Where are you in your conversation with them? Are they ready or not at all?
I'm not inside the papers of the regulator, but yeah, they are looking at the DeFi space for MiCA 2. That's a fact. And you talked about the secondary market before. This is something very specific to the permissionless environment of DeFi. And I think that they are facing these difficulties of regulating something that doesn't exist by the past in finance in general. And my view is that first, because you were thinking about maybe a crackdown of DeFi, if you think about shutting down blockchain DeFi, it will never happen because it's decentralized. There is 200K validators around the world for Ethereum and so on. So technically speaking, they can't shut down the crypto space. The question is, do they need to do so? Because obviously, if you think about stablecoin, the only way to find yield for today is on DeFi. I think that facing these difficulties of regulating this space, they will focus on the gateway, on the bridge, like the point of access to DeFi, the custodian, the wallet providers, the companies running front to access to DeFi. And progressively, I think they want to have a kind of invisible infrastructure with regulated point of access through MiCA regulated player, or maybe a new framework with MiCA 2. And I think the pragmatic view is to think about point of access, whereas the infrastructure itself, and it's what happened with internet, with TCP/IP and Swift and so on. I think it will progressively be invisible for the rest of the actors.
We have talked a lot about regulation, which works very well in theory. What I'm interested to is into the use case you see, Miles. So what are the use case of stablecoins? We have talked a lot about the payment, but do you see anything else where stablecoin could be at the heart of the operation?
I mean, well, primarily we still see stablecoins being used as part of the on-off ramp journey. You know, and we talk about dollarization and this concept of trying to increase adoption on euro stablecoins, but most of the overwhelming pairs from a trading perspective are still quoted in dollars. Until that fundamentally shifts, or there is some consumer drive to use European-denominated stablecoins for payment purposes, we're not going to see that move. I think outside of cross-border payment use cases, we're starting to see treasuries starting to introduce stablecoins into their treasury management. And I was speaking to a treasurer the other day that summed it up quite nicely for me, that they used to think about overnight, then they were thinking intraday, and he said to me, we're now even thinking every minute. And the blockchain as a technology gives us the ability to do that and to really maximize our liquidity, create efficiency as a company, particularly for multinational companies. So I think this is something we're seeing emerge quite quickly. Any company that's bringing stablecoins onto their balance sheet, they need to work with a regulated player. They need to make sure there's the stability and the security there. So MiCA as a framework helps them because they understand, okay, this is a CASP or this is a bank that has the ability also to be a custodian. Outside of that, we're also seeing an emergence of companies looking to pay their employees in stablecoins. Yes, that is under the umbrella of a cross-border payment, but it's a more sort of specialized category of that. That's something that we're seeing significant growth in. And then the one thing I'm sure a lot of people have been talking about in the last couple of days, an emerging trend is agentic payments, of course, and the whole topic of, perhaps stablecoins were not even meant for us mere humans. And maybe actually that we're going to see a meteoric rise now as agentic payments really takes off. We know that Coinbase are doing a lot on that front. We at Amina also are in that space at the moment. So, yeah.
I'll just add to that in terms of use case. So we really focus more on the capital market use case. And so when we look at tokenization in markets, we've seen a lot of tokenization done on the asset side in the last few years. What's really kind of held back adoption so far has been the cash leg, so solving for the cash leg of financial transactions, capital market financial transactions. Now, what tool is most appropriate for those? Well, it really depends on the use case. And so we don't see it necessarily as being a winner between, or a battle between stable coins and tokenized deposits, central bank money. It's horses for courses. There are different use cases that those different solutions will fit. Whether if you're looking at transactions between banks or between banks and their central bank, wholesale CBDC makes a lot of sense. If you're talking about transactions that occur within a single bank's ecosystem or a network of partner banks, tokenized deposits may be the best fit for that. But anything that's aspiring to be open loop, anything that's structured, let's say, as a fund or securitization, most likely to work on the basis of stablecoins. And so we did our first 3 ratings last year on tokenized funds. All 3 use a range of stablecoins, mainly USDC to start, but contemplating other tools to the extent there's investor demands. And that's really just a key part of the puzzle to understand that these tools coexist. You look at, for example, something JP Morgan did last year. They put their JPM token on a public blockchain base. Now that token is still permissioned, so you might ask, well, what's the point of putting it on a public blockchain if you're permissioning the token anyway? Point is that it gives them the ability to then offer products to their clients that might be issued functioning using stablecoins on base. So that's a key part of understanding how different institutions are positioning themselves in this space. If you think about why banks are looking to issue stablecoins now, it's not because they're looking to profit on reserves. It's because it's a franchise play to the extent that tokenization takes off, that they're able to offer those products to clients. And so I think that's a core piece of the use case.
Well, thank you very much. I think that we have time for each one of you to say one closing word. What do you want to say, Leopold, about, well, yields, MiCA, Genius, what we see will happen in the future, if we can?
what we are facing today with the adoption, because we are focusing on asset management and corporate treasury, even if there are regulated actors end-to-end with regulated issuer, with CASP, custodian, and so on, going on blockchain environment is assimilated to exotic investment, and treasurers, CFOs, asset managers want a premium to go on it. So we were talking about the yield and the capacity to be above some market benchmark index like Ester or Euribor. But we also have a glimmer of hope in terms of adoption with just the notion of capital efficiency. And I think this will be the main driver of adoption, because we run a discovery with 15 companies from the CAC 40 in France. And treasurers say that even for 1%, if you can put your treasury at work overnight, the weekends, or intradays, they would be ready to put some money just to get 1%. So capital efficiency could be the glimmer of hope for adoption.
Definitely. Same question, Patrick. What do you see in Europe for Circle?
I mean, just to close with maybe two quick points. First one, I think, as we mentioned earlier on, I think Genius, MiCA rather converge on that aspect, and I tend to think that other frameworks will follow the same path. It's what we're seeing in other jurisdictions as well. And then second point, I do see the secondary market innovation on that front to be a growth opportunity for Euro stablecoins, which we at Circle are very committed to. I think everyone here in the room is committed to. A lot of current Euro stablecoin supply is also locked in some of these DeFi protocols and smart contracts, and I think we should rather foster and support that and try to think about how can we make that space grow. We at Circle have been pouring a lot of resources into it, have seen strong, promising Euro see growth over the last 2 years from 35 million to over 360 million, and we really want to continue on that path. And I think secondary market is a very important point that almost every industry actor, industry association, I know Adan is here, would agree with.
Miles?
Yeah, I mean, from our perspective, regulation enables innovation. I think it's something that often, is perceived that it stifles. From our perspective, it enables, it gives everybody a clear set of rules that they have to play by. Some people might not like some of those rules, but they're clear. You cannot say that they're not clear in those cases. I mean, we are still working out what happens with the DLT pilot regime and what happens with between MiFID and MiCA, which is a constant battle for companies that are operating across those two pieces of legislation. But yeah, in the most part, MiCA gives us a clear set of rules. We are already seeing a wave of innovation come across Europe. We talked about stablecoins today, but there's all sorts of great innovations even here in Cannes, having conversations around identity, KYC, KYB. So that's what we see as an outlook in the next sort of 12 to 18 months.
Awesome, thank you. And Andrew?
If we're talking 12 to 18 months, I think we're really looking at collateralized transactions or collateral mobility on the financial institution side as being the key adoption use case. I think the corporate use case coming maybe a little bit after that, and just and one last thing, accounting treatment of stablecoins will be an important prerequisite for that. So I gathered from drinks last night that there's been some clarity on that in France. I know that in the US there's a current consultation, but yeah, that's an important boring detail to clarify.
Thank you all. If you have questions, please directly come to our panelists. I know that we all will be happy to answer any question you might have. Thank you.
Je suis ici en fait. Non mais c'est vrai que j'ai pensé pour faire tout le tour pour pouvoir... Ouais, non, c'était trop marrant. Je vais pas parler.